What if I told you that a man who bought $10,000 worth of Coca-Cola stock and held it for decades turned that investment into over $50 million? What if I told you this same man started with $100 and built a fortune of over $100 billion using principles so simple that a child could understand them? That man is Warren Buffett, and for over 50 years he's been writing letters to his shareholders that contain the most valuable investment wisdom ever put to paper. These aren't just financial reports. They're masterclasses in business, investing, and life itself. But here's what will shock you. Most people completely misunderstand what makes Buffett successful. They think it's about picking stocks, timing markets, or having insider information. They're dead wrong. The real secret to Buffett's success is something far more profound and accessible than most people realize. It's hidden in plain sight within his annual letters, waiting for anyone smart enough to decode the patterns. Today, I'm going to take you through the most explosive insights from the Essays of Warren Buffett, the collection of his shareholder letters that reveals the true methodology behind the world's greatest investing fortune. You'll discover why everything you think you know about investing is backwards, how a man who eats McDonald's and drinks cherry Coke built one of history's greatest businesses, and the shocking psychological principles that separate winners from losers in the game of wealth. This isn't just about money. It's about a completely different way of thinking about business, value, and success that will change how you see the world forever. By the end of this video, you'll understand why Buffett's approach is the exact opposite of what most investors do, and why that difference has made him one of the richest people who ever lived. Chapter 1. The Moat Discovery. Why Coca-Cola made Buffett billions. In 1988, Warren Buffett did something that shocked the investment world. He spent $1.3 billion buying Coca-Cola stock, making it Berkshire Hathaway's largest investment ever at that time. Wall Street analysts called him crazy. The stock market had crashed just months earlier, and here was Buffett putting a massive bet on sugar water. But Buffett saw something that everyone else missed. He saw what he would later call an economic moat, a business so strong, so protected from competition, that it was virtually impossible to destroy. Let me tell you the story of how Buffett discovered this moat, because it reveals everything about how he thinks. It started with a simple observation. Everywhere Buffett traveled around the world, people were drinking Coca-Cola. Not just in America, but in remote villages in China, busy streets in Brazil, corner stores in India. The red Coca-Cola sign was more recognizable than most countries' flags. But recognition wasn't what excited Buffett. What excited him was the economics behind that recognition. Buffett realized that Coca-Cola had built something almost impossible to replicate, a global addiction to a specific taste that only they could provide. You couldn't create a generic Coca-Cola the way you could create generic aspirin or generic soap. The taste was protected by trade secrets. The brand was protected by a century of marketing. And the distribution network was protected by exclusive relationships with bottlers worldwide. Here's the part that made Buffett billions. Even if a competitor had unlimited money, they couldn't recreate Coca-Cola's business. They could make a cola that tasted similar, but they couldn't make people feel the same emotional connection to their product that took Coca-Cola 100 years to build. This was Buffett's eureka moment. He realized that the most valuable businesses weren't those with the best technology or the lowest prices. They were businesses with the widest, deepest competitive moats. Think about it. What would it cost to compete with Coca-Cola today? You'd need billions for marketing, decades to build distribution networks, and even then, you'd be fighting for his scraps while Coke dominated the premium positions. That $1.3 billion investment. By 2023, it was worth over $25 billion. But Buffett had never sold a single share because he understood something that most investors never learn. When you own a piece of a business with an unbreachable moat, time becomes your friend instead of your enemy. While other investors were frantically buying and selling, trying to time markets and chase trends, Buffett was quietly collecting dividends and watching his ownership in an irreplaceable business compound year after year. This is why Buffett became wealthy, while most investors stayed poor. He stopped thinking like a trader and started thinking like a business owner. He stopped asking, "Will this stock go up?" and started asking, "Will this business be more valuable in 20 years?" The Coca-Cola investment taught Buffett that the best investment strategy isn't about being smart. It's about being patient with businesses so good that even average management can't destroy them. Chapter 2. The Newspaper Empire. How Buffett Bought Monopolies. Before anyone noticed, long before Buffett became famous for buying Coca-Cola, he was quietly building a fortune through an investment strategy so brilliant that most people didn't realize what he was doing until it was too late to copy him. Buffett was buying newspapers, small-town newspapers that everyone thought were boring, old-fashioned businesses with no growth potential. Wall Street ignored them completely, but Buffett saw what others missed. These weren't just newspapers. They were local monopolies disguised as media companies. Let me tell you the story of the Buffalo Evening News, because it perfectly illustrates Buffett's genius for finding hidden monopolies. In 1977, Buffalo, New York, had two newspapers, the Morning Courier-Express and the evening Buffalo News. Most investors saw this as a problem. Competition meant lower profits, price wars, and uncertain futures. Buffett saw it as an opportunity. Buffett understood something about the newspaper business that financial analysts missed. In most cities, there was only room for one profitable newspaper. The economics of the business, fixed costs for printing and distribution, limited local advertising dollars, meant that whoever had the largest circulation would eventually drive their competitor out of business. The Buffalo News had stronger circulation and better economics than their competitor. Buffett realized that if he bought the Buffalo News and waited patiently, he would eventually own the only newspaper in Buffalo, a local monopoly with pricing power that most businesses could only dream of. That's exactly what happened. The Courier-Express went out of business in 1982, leaving the Buffalo News as the only daily newspaper in the city. Overnight, Buffett owned a monopoly that generated massive cash flows with virtually no competition. But here's the brilliant part. Buffett repeated this strategy across the country. He bought newspapers in cities where consolidation was inevitable, then waited for economics to eliminate his competitors. He owned papers in places like Omaha, Nebraska, and other mid-sized cities where one newspaper could dominate. These newspapers became cash-generating machines. Local businesses had to advertise in Buffett's papers. Where else could they reach every household in the city? This gave Buffett incredible pricing power. He could raise advertising rates year after year because his customers had no alternatives. The genius of Buffett's newspaper strategy wasn't just buying monopolies. It was buying monopolies before they became obvious to everyone else. By the time other investors realized what Buffett had done, all the good opportunities were gone. This taught Buffett a crucial lesson that would guide his investing for decades. The best businesses aren't necessarily the most exciting ones. They're businesses with competitive advantages so strong that competitors can't survive. Years later, when asked about his newspaper investments, Buffett said something that reveals his entire investment philosophy. "I'd rather own a wonderful business at a fair price than a fair business at a wonderful price." The newspapers taught Buffett to look for businesses that could raise prices without losing customers, generate cash without major capital investment, and dominate their markets so completely that competition was futile. This mindset would later lead him to investments in insurance companies, credit rating agencies, and other businesses with similar monopolistic characteristics. But it all started with those boring small-town newspapers that made Buffett rich while everyone else was chasing the hot stocks of the day. Chapter 3. The Insurance Genius. How Buffett Built an Empire with Other People's Money. Warren Buffett's greatest business insight wasn't about picking stocks. It was about discovering the perfect business model hidden inside one of the most boring industries in America: insurance. The story begins in 1967 when Buffett bought National Indemnity, a small insurance company in Omaha, for $8.6 million. Wall Street thought he was crazy. Insurance was considered a terrible business. Unpredictable claims, regulatory headaches, intense competition. But Buffett saw something that would make him one of the richest men in history. Buffett discovered what he called float, the money that insurance companies collect in premiums before they have to pay out claims. Here's how this changed everything. When you buy car insurance, you pay your premium up front for a full year of coverage. But the insurance company might not pay claims on that policy for months or even years. In the meantime, that money sits in the insurance company's accounts, earning investment returns. Most insurance executives focused on underwriting, trying to collect more in premiums than they paid in claims. Buffett realized this was thinking too small. The real gold mine wasn't the underwriting profit. It was getting access to massive amounts of free money to invest. Let me show you the genius of Buffett's insurance strategy. Imagine you could borrow $100 billion at 0% interest with no set repayment date, and invest that money at 10% annual returns. You'd make $10 billion per year on money that didn't cost you anything. That's essentially what Buffett's insurance companies do with float. By 2023, Berkshire Hathaway's insurance operations held over $165 billion in float. Even if they broke even on underwriting, collecting just enough premiums to pay claims, Buffett could invest that $165 billion and generate massive returns. But here's where Buffett's strategy became truly brilliant. His insurance companies didn't just break even on underwriting. They actually made money. For most years, Berkshire's insurance companies collected more in premiums than they paid in claims, meaning Buffett was actually paid to borrow that money. Think about this. Buffett built a business that pays him to borrow enormous amounts of money, then lets him invest that money for decades before having to return it. It's the closest thing to a legal money printing machine that exists in capitalism. This is why Buffett could make massive investments, like the $1.3 billion Coca-Cola purchase. He wasn't using his own money. He was using float from his insurance companies. When those investments paid off, the profits belonged to Berkshire shareholders, but the original capital came from insurance customers who wouldn't need their money back for years. The insurance strategy also explained why Buffett preferred businesses that generated cash rather than businesses that consumed cash. Every dollar of cash flow from Coca-Cola, newspapers, or other investments could be reinvested immediately, compounding Berkshire's returns at an accelerating rate. But the most brilliant part of Buffett's insurance empire was how he used it to buy more insurance companies. Every acquisition gave him access to more float, which he could invest to generate more profits, which he could use to buy even more insurance companies. This created what Buffett called a virtuous cycle. More insurance companies meant more float. More float meant higher investment returns. Higher returns meant more capital to acquire more insurance companies, and the cycle continued expanding for decades. By the time competitors realized what Buffett had done, it was too late. He'd built such a massive insurance operation with such enormous float that no one could replicate his strategy. Berkshire Hathaway had become the ultimate compounding machine, powered by other people's money. The insurance insight taught Buffett that the best businesses aren't just profitable. They generate capital that can be redeployed into even more profitable opportunities. This would become the foundation for everything Berkshire Hathaway accomplished over the next 50 years. Chapter 4. The Management Secret. Why Buffett lets CEOs run wild. When Warren Buffett bought See's Candies in 1972 for $25 million, he made a discovery that would revolutionize how he thought about business management. The discovery came not from studying financial statements or market analysis, but from watching how the company's existing management team operated after the acquisition. Most investors who buy companies immediately start making changes, new strategies, new systems, new people. Buffett did the opposite. He left See's Candies completely alone. The results were extraordinary. Without any interference from Buffett, See's Candies generated over $2 billion in cumulative profits over the next 50 years. The management team that was running the company when he bought it continued running it exactly the same way, and profits grew year after year. This taught Buffett one of his most valuable lessons. Great businesses run themselves. Great managers don't need supervision, and great investors know when to stay out of the way. From his shareholder letters, we learn that Buffett developed what he called the hands-off management philosophy. When Berkshire Hathaway bought a company, Buffett would typically have one conversation with the CEO that went something like this: "Keep running the business exactly the way you've been running it. I'm not going to second-guess your decisions or interfere with your operations. Just send me the financial reports each month so I know how we're doing. If you need capital for growth opportunities, call me. Otherwise, I'll talk to you next year. This approach shocked business schools and management consultants, who taught that successful companies required constant oversight, detailed strategic planning, and centralized control. Buffett proved them wrong by building one of the most successful conglomerates in history with almost no corporate bureaucracy. The story of Nebraska Furniture Mart illustrates this perfectly. When Buffett bought the company in 1983, it was run by Rose Blumkin, an 89-year-old immigrant who had built the business from nothing. Instead of bringing in professional managers or implementing modern systems, Buffett let Mrs. B, as she was known, continue running the company her way. Mrs. B had no formal education, couldn't read English, and kept most of the business details in her head. By conventional management standards, she was completely unqualified to run a major furniture retailer. But she understood her customers, her suppliers, and her market better than any MBA could. Under Buffett's hands-off approach, Nebraska Furniture Mart became one of the most profitable furniture retailers in America. Mrs. B worked until she was 103 years old, and the business thrived under her leadership for decades after Buffett's acquisition. This experience taught Buffett to look for companies with what he called managers who love their businesses. These were CEOs who would run their companies with passion and excellence, regardless of who owned the stock. They didn't need incentive programs or performance monitoring. They were internally motivated to succeed. Buffett realized that trying to improve great management was like trying to improve a great musician by giving them more practice. If they were already great, interference would only make them worse. This management philosophy had another brilliant benefit. It attracted the best entrepreneurs to sell their companies to Berkshire Hathaway. When successful business owners wanted to sell, they knew that Buffett would let them continue running their businesses without interference. This gave Berkshire access to acquisition opportunities that other buyers couldn't get. The hands-off approach also allowed Buffett to run an enormous conglomerate with a headquarters staff of fewer than 30 people. While other large corporations had thousands of corporate employees managing and monitoring their subsidiaries, Berkshire operated with almost no overhead. This taught Buffett that the best management strategy is often no management strategy. When you own great businesses run by great people, the smartest thing you can do is get out of their way and let them work their magic. Chapter 5. The Patience Paradox. Why Buffett's boring strategy beats Wall Street. In 1999, at the height of the dot-com bubble, Warren Buffett was being mocked by Wall Street analysts and financial media. While tech stocks soared 100% or 200% in a matter of months, Buffett's Berkshire Hathaway was barely breaking even. Critics called him outdated, irrelevant, and out of touch with the new economy. One particularly brutal article in Barron's was titled, "What's Wrong, Warren?" and suggested that Buffett's old-fashioned value investing approach was dead. The article pointed out that Berkshire had significantly underperformed the Nasdaq for several years running. Buffett's response revealed the psychological principle that separates great investors from everyone else. In his 1999 shareholder letter, Buffett calmly explained why he wasn't buying dot-com stocks. He didn't understand the businesses, couldn't predict their future cash flows, and couldn't identify sustainable competitive advantages. While everyone else was getting rich, on paper, from internet stocks, Buffett stuck to his boring strategy of buying understandable businesses at reasonable prices. The critics seemed to be right. By early 2000, many dot-com investors had doubled or tripled their money, while Buffett looked foolish for missing the greatest bull market in history. Then, March 2000 arrived. The Nasdaq crashed 78% from its peak. Trillions of dollars in paper wealth evaporated. Companies that had been worth billions went bankrupt. Investors who had felt like geniuses just months earlier lost their entire portfolios. Meanwhile, Buffett's boring businesses, Coca-Cola, insurance companies, newspapers, kept generating steady profits throughout the crash. Berkshire's stock price remained stable while the rest of the market collapsed. This wasn't luck. This was the result of what Buffett calls the patience paradox, the counterintuitive principle that the best long-term investment strategy often looks wrong in the short term. Buffett had learned this lesson decades earlier when he started investing. In his early years, he would buy stocks that were so cheap they seemed like obvious bargains, then watch them sit flat or even decline for months or years before finally recognizing their true value. This taught him that great investing requires a psychological makeup that most people don't have. The ability to be comfortable being wrong in the short term while waiting for long-term logic to prevail. The story of Buffett's investment in American Express illustrates this perfectly. In 1963, American Express was caught in a massive scandal involving fraudulent warehouse receipts that cost the company hundreds of millions of dollars. The stock crashed, and most investors assumed the company was finished. But Buffett saw something different. He spent weeks visiting restaurants, hotels, and stores, watching how people used American Express cards and travelers' checks. Despite the scandal, customers still trusted the American Express brand and continued using their services. Buffett realized that American Express had built something more valuable than most people understood: customer trust and habit. Even a massive scandal couldn't destroy what had taken decades to build. He invested 40% of Berkshire's assets in American Express stock at rock-bottom prices. For 2 years, the investment went nowhere. Critics questioned Buffett's judgment. Some shareholders demanded he sell. Buffett held on. Eventually, American Express recovered from the scandal and became one of the most profitable financial companies in America. That patient investment made Buffett tens of millions of dollars and taught him a crucial lesson about investor psychology. Most investors can't handle being wrong temporarily, even when they're right fundamentally. They sell great investments at exactly the wrong time because they can't tolerate the discomfort of watching their stocks decline while they wait for value to be recognized. Buffett developed what he called emotional arbitrage, the ability to profit from other investors' psychological weaknesses. When fear dominated markets, Buffett bought. When greed dominated markets, Buffett sold or simply waited. This patience paradox explains why Buffett's annual letters often seem almost boring compared to the excitement of Wall Street. While traders were obsessing over quarterly earnings and daily stock movements, Buffett was thinking about what businesses would be worth in 10 or 20 years. The patience paradox became Buffett's greatest competitive advantage because it's the one advantage that can't be copied by intelligence or technology. You either have the psychological makeup to invest patiently, or you don't. Chapter 6: The Compound Miracle. How $10,000 became $50 million through time. In 1988, Warren Buffett made a prediction that seemed almost impossible. He told Berkshire Hathaway shareholders that if they held their Coca-Cola stock for 30 years, a $10,000 investment could grow to over $50 million. Wall Street analysts laughed. A 500-to-1 return, even optimistic projections seemed to max out at 10-to-1 or 20-to-1 returns over 3 decades. Buffett's prediction seemed like fantasy. By 2020, that fantasy had become reality. Buffett's Coca-Cola prediction proved not just accurate, but conservative. The investment had actually performed even better than his original forecast. How was this possible? The answer reveals the most important concept in all of investing, what Einstein allegedly called the most powerful force in the universe: compound interest. But Buffett's genius wasn't just understanding compound interest mathematically. It was understanding compound interest psychologically and practically in ways that most investors never grasp. Let me show you the numbers that changed how Buffett thought about wealth. Year 1, $10,000 grows to $11,000, 10% return. Year 5, $10,000 becomes $16,105. Year 10, $10,000 becomes $25,937. Year 15, $10,000 becomes $41,772. Year 20, $10,000 becomes $67,275. Year 25, $10,000 becomes $108,347. Year 30, $10,000 becomes $174,494. Wait, that's only $174,494, not $50 million. What's the difference? The difference is that Buffett wasn't just earning 10% annual returns. He was earning those returns on businesses that were themselves compounding their intrinsic value at accelerating rates. Coca-Cola wasn't just paying dividends and appreciating in stock price. The company was expanding globally, raising prices, improving efficiency, and building stronger competitive moats every year. The business itself was becoming exponentially more valuable. This taught Buffett the crucial difference between simple compound interest and business compounding. A bond might compound at 5% annually forever, giving you predictable but limited returns. A great business compounds its intrinsic value at accelerating rates as it grows stronger and more dominant. Buffett realized that the best businesses create what he calls compound machines, enterprises that not only generate returns, but reinvest those returns into opportunities that generate even higher returns in the future. Here's how this played out with Coca-Cola. The company used its profits to expand into new countries, where it built new bottling plants and distribution networks. These investments generated more profits, which funded expansion into even more countries. Each new market made the global Coca-Cola system more valuable and harder for competitors to challenge. Meanwhile, Coca-Cola was raising prices globally, not just to keep up with inflation, but to capture more value from its growing brand strength. Higher prices meant higher margins, which meant more cash to reinvest in growth, which meant even stronger competitive positions. This created what Buffett calls a virtuous cycle of compounding. Profits funding growth, growth creating stronger competitive positions, stronger positions enabling higher profits, and the cycle accelerating over time. But here's the psychological insight that separates Buffett from most investors. Understanding compound miracles requires giving up the satisfaction of quick profits in favor of enormous long-term gains. Most investors can't do this. They see their $10,000 investment grow to $15,000 in 2 years and think, great, I'll take my 50% profit and find the next winner. They never experience the miracle of what happens in years 20 to 30 of compound growth. Buffett learned to think differently. Instead of asking, how much did I make this year? He asked, how much will this be worth in 20 years? Instead of measuring success quarterly, he measured it by decades. This is why Buffett famously said his favorite holding period is forever. He understood that the biggest gains from compound growth happen in the later years, but only if you're patient enough to wait for them. The compound miracle taught Buffett that time is the most valuable asset an investor can have, more valuable than intelligence, more valuable than capital, more valuable than inside information. Time turns small investments in great businesses into life-changing wealth, but only if you're disciplined enough to let it work. Chapter 7. The Mistake Confession. How Buffett's biggest errors made him richer. Warren Buffett's shareholder letters contain something almost no other CEO provides: brutal honesty about his mistakes. In his 1989 letter, Buffett wrote about what he called the $11 billion error, a mistake so costly it could have bankrupted most companies. The story begins with Berkshire Hathaway itself, which started as a failing textile company that Buffett bought in 1965. For 20 years, Buffett poured money into the textile business, trying to make it profitable in an industry that was dying due to foreign competition. Every year, the textile division lost money. Every year, Buffett invested more capital, trying to turn it around. Every year, he told shareholders that this would be the year the textile business became profitable. Finally, in 1985, Buffett shut down the textile operations entirely. He calculated that over 20 years, he had wasted over $200 million trying to save an unsalvageable business. But the real cost was much higher. If Buffett had invested that same $200 million in Coca-Cola, Washington Post, or other great businesses during those 20 years, it would have grown to over $11 billion by 1989. The textile division hadn't just cost $200 million in direct losses. It had cost $11 billion in opportunity costs. This mistake taught Buffett one of his most valuable lessons. The most expensive mistakes aren't the investments that lose money. They're the great investments you don't make because your capital is tied up in mediocre businesses. But here's what makes Buffett extraordinary. Instead of hiding this mistake or making excuses, he used it to completely change his investment philosophy. Before the textile experience, Buffett followed what he called the cigar butt approach, buying terrible businesses at extremely cheap prices, hoping to get one or two good puffs before they died completely. This strategy had worked when he was managing smaller amounts of money, but it couldn't work with large capital. After the textile disaster, Buffett shifted to what he called buying wonderful businesses at fair prices instead of fair businesses at wonderful prices. This seemingly small change in philosophy would make him billions of dollars over the following decades. The textile mistake also taught Buffett about what he calls the sunk cost fallacy. Once he had invested money in the textile business, he kept throwing more money at it because he didn't want to admit the original investment was wrong. This is exactly how most investors destroy their wealth. They hold losing investments too long and sell winning investments too quickly. Buffett learned to ask a different question. If I owned no shares in this company today, would I buy it at the current price? If the answer was no, he would sell regardless of what he had originally paid. Another confession from Buffett's letters reveals an even more expensive mistake: the investments he didn't make. In the 1990s, Buffett understood Microsoft's business model and competitive advantages, but he didn't buy the stock because he felt it was outside his circle of competence. Microsoft stock rose over 5,000% during the period when Buffett was avoiding it. Missing Microsoft may have cost Berkshire shareholders more than any other single decision in the company's history. But even this mistake taught Buffett valuable lessons. He realized that his circle of competence had been defined too narrowly, and he began studying technology companies more seriously. This eventually led to major investments in Apple, which became one of Berkshire's most profitable positions ever. The most powerful insight from Buffett's mistake confessions is how he used them to improve his decision-making process. Instead of just admitting errors, he analyzed why he made them and built systems to prevent similar mistakes in the future. For example, after missing several great investment opportunities because he was too conservative on price, Buffett developed what he calls the 25% rule. If a great business becomes available at a price 25% below his estimate of fair value, he buys immediately rather than waiting for an even better price. This willingness to acknowledge and learn from mistakes is what separated Buffett from other investors who made similar errors but never improved their processes. Buffett's mistakes became stepping stones to better decisions, while most investors' mistakes just repeated themselves in different forms. The confession strategy also created trust with shareholders who knew that Buffett would tell them the truth about both successes and failures. This trust allowed Berkshire to raise capital at low costs and attracted the best managers and business owners who wanted to work with someone they could trust completely. Chapter 8: The Succession Secret: How Buffett Built a Fortune That Will Last Forever. As Warren Buffett entered his 90s, investors around the world began asking the same terrifying question: what happens to Berkshire Hathaway when Buffett is gone? Would the company collapse without its legendary founder? Would the investment returns disappear along with Buffett's genius? Buffett's answer reveals perhaps his greatest insight about building lasting wealth. The best businesses don't depend on any single person, no matter how brilliant that person might be. In his recent shareholder letters, Buffett explained his succession philosophy using a simple but profound principle. Berkshire's competitive advantages are institutional, not personal. What does this mean? It means that Buffett deliberately built Berkshire Hathaway to succeed without him. The story of how Buffett designed his own obsolescence began decades ago, when he realized that personal genius is not a sustainable, competitive advantage. Smart people retire, get sick, or die. But well-designed systems, cultures, and business models can last for centuries. Buffett studied the world's most enduring institutions, universities that had thrived for 800 years, banks that had survived multiple economic collapses, companies that had remained profitable for over a century. He discovered that lasting institutions all shared certain characteristics that had nothing to do with the brilliance of any individual leader. First, they had simple, understandable business models that didn't require constant innovation or adaptation. They did a few things extremely well, rather than trying to be everything to everyone. Second, they had strong cultures that attracted and developed excellent people at every level. These cultures were so deeply embedded that they persisted through multiple generations of leadership changes. Third, they had financial structures that could withstand almost any economic crisis. They maintained large cash reserves, avoided dangerous levels of debt, and generated steady cash flows from diversified sources. Fourth, they had decision-making processes that prevented catastrophic errors while allowing for intelligent risk-taking. They had checks and balances that no single person could override. Buffett consciously built all of these characteristics into Berkshire Hathaway. The company's business model, buying great businesses and holding them forever, is so simple that it doesn't require genius to execute. The company's culture attracts managers who love their businesses and don't need supervision. The financial structure is virtually unbreakable, with massive cash reserves and no meaningful debt. But perhaps most importantly, Buffett documented his decision-making processes in his annual letters so thoroughly that future leaders could follow the same principles even without his personal involvement. The succession plan Buffett developed splits his responsibilities among multiple people rather than trying to find one person who could replicate everything he did. Investment decisions will be handled by specialists who have proven their ability to generate excellent returns. Business operations will continue to be managed by the same CEOs who have been running Berkshire's subsidiaries for years. This approach reflects Buffett's understanding that sustainable success comes from systems, not individuals. Even if Berkshire's future leaders are less brilliant than Buffett, they can still generate excellent results by following proven processes and maintaining the company's core principles. The succession strategy also reveals Buffett's ultimate insight about wealth building. The greatest fortunes are built by people who think beyond their own lifetimes. Instead of trying to maximize personal wealth, they build institutions that will create value for generations. This long-term thinking shaped every major decision Buffett made. He didn't just buy businesses that would make him rich. He bought businesses that would continue generating wealth long after he was gone. He didn't just develop investment strategies that worked in his era. He developed strategies that would work in any economic environment. The succession secret teaches us that true wealth building isn't about getting rich quick. It's about building something permanent that will keep working even when you stop working on it. Your Buffett fortune starts today. Everything you've just learned about Warren Buffett's success comes down to one simple truth. The principles that made him the world's greatest investor are completely available to you right now. You don't need billions of dollars, Harvard connections, or insider information. You just need to think differently than everyone else. But here's what will separate you from the millions of people who read about Buffett but never apply his lessons. You need to start acting on these principles today, not someday, when you have more money, more knowledge, or more confidence. The biggest lie investors tell themselves is, "I'll start investing seriously when I have more capital." Buffett started with $100. The amount doesn't matter. The principles do. Here's your Buffett-inspired action plan that you can implement immediately. First, start thinking like a business owner, not a stock trader. Every investment you make should pass the Buffett test. If I could never sell this investment, would I still want to own it? If the answer is no, don't buy it, regardless of what you think the stock price will do. Second, build your economic moat knowledge. Spend the next 30 days studying businesses with competitive advantages so strong that competitors can't destroy them. Look for companies with brand power like Coca-Cola, network effects like credit card companies, or regulatory advantages like utilities. These are the only businesses worth owning for decades. Third, develop Buffett's patience paradox. Set up automatic investments that you can't touch for at least 10 years. The greatest wealth destruction happens when investors sell great businesses during temporary market panics. Remove your ability to make emotional decisions by making your best investments untouchable. Fourth, create your own float strategy. You don't need to own insurance companies to benefit from Buffett's float principle. Every dollar you can delay spending is a dollar you can invest for compound growth. Pay yourself first, delay gratification, and use time as your wealth-building weapon. Fifth, start your mistake journal. Beginning today, write down every investment decision you make and why you made it. When investments don't work out, analyze what went wrong and how you can avoid similar mistakes. Buffett's wealth came from learning from errors, not from avoiding them entirely. Sixth, ignore the noise completely. Stop checking stock prices daily. Stop reading financial news that focuses on short-term market movements. Stop listening to anyone who talks about timing markets or predicting economic cycles. Buffett built his fortune by ignoring Wall Street's hysteria and focusing on business fundamentals. Most importantly, understand that this is not about getting rich quick. Buffett took 50 years to build his fortune. The compound miracle only works if you give it decades to operate. But here's what most people miss. Starting 10 years earlier matters more than being 50% smarter or having twice as much capital. The brutal truth is that most people will read about Buffett's principles, feel inspired for a week, then go back to their old habits of chasing hot stocks and panicking during market declines. They'll spend their lives wondering why their investment returns are mediocre, while Buffett's disciples build substantial wealth using the exact same principles available to everyone. Don't be most people. The difference between Buffett and every investor who failed to replicate his success isn't intelligence or access. It's the discipline to follow boring principles consistently for decades, while everyone else chases excitement. You have two choices right now. Choice 1. Close this video. Feel temporarily inspired, but continue investing the same way you always have. Keep hoping for shortcuts. Keep chasing trends. Keep making the same emotional mistakes that prevent compound wealth building. Choice 2. Commit to thinking like Warren Buffett starting today. Accept that building real wealth takes decades, not months. Focus on buying pieces of extraordinary businesses at reasonable prices, then holding them while compound growth works its magic. The first choice is easy and comfortable. It's also guaranteed to keep you financially mediocre forever. The second choice requires patience, discipline, and the psychological strength to be different from everyone around you. But it's the only choice that leads to extraordinary wealth. Warren Buffett proved that an ordinary person from Omaha, Nebraska, could become one of the richest people in history, using principles so simple that anyone can understand them. The principles are available to you right now in his own words through decades of shareholder letters. The only question is whether you have the discipline to follow them. Buffett's fortune wasn't built on secret information or market timing. It was built on patience, discipline, and the understanding that time transforms good businesses into great fortunes. Your compound miracle starts the moment you decide to think like an owner, not a trader. Your wealth-building journey begins when you choose boring consistency over exciting speculation. The same principles that made Buffett $100 billion are waiting for you to apply them. What are you waiting for? Start today. Start small. Start with the mindset that will transform your financial future over the next 30 years. Your future wealthy self is counting on the decisions you make right now. Don't let that person down.